Good morning. Please be seated. We are here for oral argument in cause number TX17 0005, Roadsafe versus Ador. These proceedings are being video and audio recorded, so we ask counsel to please identify yourself and your client at the beginning of your argument. Each side will have 20 minutes. Appellant's counsel is responsible for watching the clock to reserve a portion of that time for rebuttal if you desire. Also, we've read the briefs. We have discussed this case in conference, so we are familiar with your arguments. At this point, you may proceed, counsel.
Thank you, Your Honors. Good morning. My name is Stephen McFarland from McFarland Law, and my co-counsel at the table is Robert Porter from Porter Law Firm. Your Honors, this case is about the taxation of personal services. It tests the extent and the scope of the state's taxing authority to include personal services into the personal property rental classification of ARS 425071. That is our issue. This is not a barricade rental case. Roadsafe Traffic Systems, which I'll refer to as RTS or Roadsafe, reported its revenues generated from providing traffic control equipment and paid over $1.26 million in TPT during the audit period. Those reported gross receipts included the labor that was involved to set up what I call the traffic control equipment, TC equipment. And specifically, the ADOR wants the funds received by RTS for the personal services of officers and flaggers, as well as for drafting TCP plans to be included in the gross receipts under the personal property rental classification.
Now we're talking now about a transaction privilege tax, correct?
That's correct.
All right. And haven't we focused in that on what you're in the business for, correct?
That's correct.
And that's actually, it's in the statute. And in this case, they're in the business of renting road equipment, whatever.
Yes.
And they provide in this renting provisions as part of that, flaggers, police officers that manage the equipment or manage the traffic as it relates to the equipment. Why isn't that just part of the business?
Well, Your Honor, Roadsafe has many lines of business, okay? They do road striping. They also they provide work zone safety areas for road construction workers, and that by supplying the traffic control equipment, okay? And by that, we don't just mean barricades, okay? These are cement barricades. These are plastic barricades. These are street plates, flags, signage, both electronic as well as just standard road signs. It's the backhoes that are used to move this heavy equipment on and off of the road.
Do they provide flaggers in situations that are unrelated to the rest of the business?
Your Honor, the testimony is that yes, they do. There are some invoices where police officers let me step back. There are invoices that separately invoice police officers for certain projects. For example, in the record, there is a number of invoices that were involved in a sunk construction road reconstruction project, and that went on for over a year and a half. And so during that time, the
no
provision.
Other products provided or services provided?
Yes, there was. In that situation, there was other products, but it's sort of, if they needed.
It wasn't incidental to the products?
Well, we're saying, Your Honor, that it was not incidental to the products because they have that separate line of business. They use the traffic control equipment when they road stripe. Sometimes they just provide traffic control equipment.
Talk about a separate area of business. Typically, let's use divisions. There are different divisions of a parent corporation. How is this labor-related activity separated within the accounting, hiring, et cetera, within the company?
Yes. And that was, of course, some, we did some extensive discovery on that. But basically, it came down to the books and records are able to disclose the revenues that were generated from each of those activities. If there were police hired, the books and records were able to identify the specific invoices where it would say police officer, and it would give a line item identification for that.
But in the gestalt of the business plan, what you do is rent road control devices and work on roadways, correct?
That's correct.
And so when we talk about, is this a different division? Is the division supplying flaggers, supplying police officers for traffic control, coming up with traffic control plans? None of that is done independently of the rental business.
I wouldn't agree with that, Your Honor.
So there are instances where you've hired out police officers to do traffic control for events and no rental equipment was on scene.
We did not have any invoices that demonstrated that, but there are invoices where there were only police officers that were invoiced for a certain period of time.
Because the devices and the rental equipment was already in place.
Not necessarily, but and I can't answer that clearly, Your Honor, because sometimes they would have all four of their lines of business involved in a project. Sometimes it would only be one aspect of it. So there was no uniformity across the board where you can say every time that they had a rental activity, there was also a flagger or a...
How about the converse? Every time there was a flagger, a traffic control plan, or a police officer employed by the company, there was also rental equipment at the site.
My understanding with that is that when there would be a request by a general contractor for Roadsafe to provide a police officer or a flagger, they would go ahead and do that. That was really not generically done all the time. Most of the time, the general contractors provided their own traffic control personnel. And secondly, again...
I think you're missing the point, or maybe you are and you just don't answer the question, is you're not, the business was not held out to say, we're an employment agency, come here and get your flaggers or your off-duty police officers.
No, normally
the business was renting equipment or other functions that, and if in using those, you need off-duty police officers or flaggers, we will help you get that. Isn't that what your business was?
It wasn't that intertwined, okay, and to where you can't separate it out, okay. What is intertwined is...
Hold on, it's not whether you can separate it out. Are you in the business of providing off-duty police officers and flaggers in and of themselves?
The answer to that is yes.
Okay, well, how much did you generate during the tax years?
For
just that.
Just the police officers.
I need a police officer to monitor something going on in front of my house. Do I call up your company and say, can you get me an off-duty police officer?
Yeah, and the answer to that, Your Honor, is somewhere around $2 million. Okay, there were three components to the to the traffic control activity. One was the police officers, the second was the flaggers, and the third.
Revenue. I have written down what what you put in, and I have total revenue for police officers, and let's just focus on that.
Okay.
Of $1,122,113.
Correct.
What percentage of that was related to your use of police officers in dealing with equipment, or just police officers, just, I need an off-duty police officer?
Yeah, that, I wouldn't have that information. Yeah, we never made that computation.
What about flaggers? The same question.
Yeah, we made that in relation to the gross revenues of the of the Class 14 business. Okay, the percentages there. Okay, and if that is what your question is,
I'm just saying, how many, what percent, what was your revenues? If you're saying we're in the business of renting out off-duty police, which I find offensive to say that, but okay, if we're in the business of providing off-duty police officers or flaggers to people unrelated to the other aspects of our business, how much revenue do you generate from that?
Yeah, it was $22 million total revenue for Class.
Well, that, because I have 29,494,006, and then that's your gross revenue, and then you had deductions after that.
Yeah, that gross revenue included all classes, Your Honor.
Okay.
But when we look just at the Class 14 personal property rental, the total was $22,800,000. There were deductions for non-taxable amounts, arriving at a taxable gross of $21,118,000, and of course, then the percentage would be put into the police officer and the flagger there. The bottom line, your officer, is that the flagger revenue was, let's just say, estimated 5%. The police officer maybe at 4% or 3%, and the TC revenues was 0.9% or 1%.
But it's there.
Go ahead.
There's no breakdown from when those services were provided in conjunction with the equipment that was provided, as opposed to services that were completely unrelated to any equipment. You don't have a separate breakdown for that?
No, we did not do that. And
isn't that part of the kind of readily ascertainable? If we're saying this is a separate business, if even at this point we don't have those numbers, how can we say it's readily ascertainable that that's for a separate business?
I think, Your Honor, the analysis has to begin with the statute, because that's what the Supreme Court has directed our courts to begin with, is the statutory language. And the statutory language and the analysis of that, basically the pith of the argument there is that the labor that is part of the rental transaction is the service that is includable in the TPT for personal property rental. That is to say, it's limited, it's encompassed to the labor that's involved with the TC equipment.
Only the
delivery,
picking up, setting up.
Right, and that's what the statute specifically says, a part of the rental transaction. The ADOR has argued that, no, it's in conjunction with the entire rental activity. That would pull in all sorts of activities. Why not include the revenues for the warehousemen who take the equipment down and warehouse it and put it back into inventory? Why not tax the supervisor who goes down and views the project before it even starts and says, okay, we need this many barricades and we can provide this? Why not include that?
If it was separately charged to the client, then why wouldn't you include that information? I mean, that's the problem, is that this is a separate charge.
But it's more closely related than hiring a police officer who never touches the traffic control equipment, or a flagger who never touches the traffic control equipment.
Isn't it more akin to if you rented, say, if someone was to rent a forklift, and they say, oh, by the way, I need a driver, and they said, okay, well, we can provide you with a driver. Wouldn't that be part of the rental business?
Well, the Great All case, Your Honor, says if there's equipment with an operator that it is not renting.
It's not rental.
It's not renting. That's the Great All case, yeah.
Well, okay, well, we may differ on that, our interpretation of that case.
Okay.
Go ahead. It just seems to me that you're talking about a very small fraction of the business that that is not a separate business from the overall business of what you're talking about, the rent.
Yes, but that's really not the test, though. Here, I don't think, Your Honor, because for one thing, just from the perspective of the industry and companies that have lines of business that include rental activity, we want to have some sort of clarity here and some sort of direction, and the statutes give us that, okay? Statute 5001, subparagraph 7, states that if there are services provided that are a part of the sales or rental transaction, that is included in the TPT base. And that gives us clarity. That gives the industry and other businesses clarity here to say, gee, anything in conjunction with the rental activity, well, let's go back to my example. Is the warehouseman then all of a sudden going to be liable for TPT, the revenues there? We don't know, okay? And the statutes are clear. I think they're clear and unambiguous.
And what do you make of the Holmes versus Narver test?
Your Honor, I think that differs from our situation and is somewhat distinguishable. Holmes and Narver, I believe, is a case where there was intertwined businesses and lines of business. In our case here, we have in the record, in deposition testimony and substantiated by the invoices, showing that the TC activity was itemized and separately stated on each invoice. I would like to reserve some. Sure.
I'll give you a little more time. If I could, before I forget, with you were asking about why wouldn't it also encompass the people in the warehouse? Isn't that a cost that's already been passed along? Isn't that part of what you've already factored into providing the service to the customer? Hasn't that already been included essentially?
Well, yes. From a business aspect, I would imagine that all your overhead.
I mean, that would be different than a flagger.
Right. You're talking maybe direct costs versus overhead component of the pricing is my answer to that, if I can just throw that out. But yeah, good comment.
Thank you.
Yeah.
Good morning, Your Honors. May it please the Court. I'm Ben Updike for the Arizona Department of Revenue. I wanted to address a few things that were raised here. First of all, warehousemen, there's nothing in the record to show that there was income or revenues from these warehousemen. So TPT is a tax on revenues. The costs aren't taxed. I don't know where he's going. So it's a tax on revenues. And in this case, the company Roadsafe had revenues from 3 buckets. It had revenues from a small amount of sales or retail, had revenues from road striping or some construction, and it had revenues from a 3rd bucket from its rental activities. So all of the record supports that there were 3 buckets from the beginning. When it requested a license, it said we're going to be in these 3 activities, these 3 businesses. Then during the audit, when the auditors reviewed everything, they said, okay, we can see that your accounting tracks things in 3 revenues. And the department put everything into these 3 buckets of 3 different kinds of revenues. And then we got to tax court, and suddenly there's and in the argument, there's a 4th bucket, supposedly a 4th division or a fourth company that's providing all of these things. During the discovery at tax court, they were unable to show answers to some questions like how much was solely, we requested those. Can you please show us how much for flaggers that are unrelated to these projects for your large construction companies where you also rented equipment? And they said that possibly they might be able to find that information through manipulation of their accounting system, but they didn't have it and they didn't provide it. And at this point, it's too late to try to make an argument they could have.
Hypothetically speaking, if they had provided that, does that change your analysis of the taxability of those activities?
It's more information to show the first prong of the Holmes and Narber case that it could have been easily ascertainable. Their failure to provide it makes them fail that first prong.
Okay, but let's say they did provide it. Does that change whether or not this would be taxable income in your mind under the statute?
Well, this is all hypothetical, but had they provided and shown that only a small fraction of the flagger revenue was provided only, or police officers were not rented, but they were provided for a birthday party or something, if that was a fraction, 1% of the total for the remaining flaggers, then that would show that it was not a separate line of business because it's such a small portion that...
Moving to the other prongs of the...
Moving to the second prong, with which how much is it? Is it a substantial amount? And the answer is no. I mean, it would prove the department's case again that there's only a very small part that they could. They weren't able to provide it. They weren't able to show that they all were. It's assumed that it's going to be less than what they showed for the amounts of the total amounts of flaggers and police officers and traffic control plans. And if those amounts are not substantial on their own, then a reduced fraction of those would be less substantial. It would mean they were less able to.
The reply brief suggests that the percentage was about 24%.
That math is absolutely incorrect, Your Honors. They did a tax rate of 5%, which is not the tax rate. You can take judicial notice of the tax rate tables on the department's website. It goes back for a long time. And it was between 6.6 when you include the county and maybe 7.2 or 3. So it was a higher rate, so their math was just done incorrectly. They also added all of them together.
At what point would you view it as being insubstantial? Is there a cutoff point? Is it less than 10%? Is it?
Well, we have the Arizona rent-a-car case, which $2 million out of $90 million is not substantial enough. And we have the Holmes and Narber case that says approximately 43% is. I don't know if there is a cutoff. There hasn't been anything. I would say that we can look at these amounts and see that they're not the 24%. The only way you get 24% is to add all three together, and the only thing that links these three activities is the rental activity. So that's trying to link them without linking them and mentioning rental. So it's just a logical inconsistency. If you look at them separately, which they have to be, otherwise you have to say that they're rental because that's how they're related, then they would be 3% in the department's numbers, 4%, 3.8, 0.6%, and those numbers are very close to the same numbers as in the rent-a-car case.
When we're comparing that, do we look at the gross, because I have two numbers. I have gross revenues of 29,494,006, and I also have gross numbers of 22,898,709. But the revenues generated under both of those are the same. So are we comparing the gross revenues minus certain deductions, or are we looking just simply at gross revenues when we're trying to determine the percentage factor involved?
Well, this case is different from some of the other cases that mention these, because in the other cases there's only one other business they're trying to split out of. Here we're trying to split out of multiple businesses so they also had sales and contracting. So in this case, because there's multiple businesses, I would compare it to the gross revenue of all of the businesses, because they're trying to say we have established another business that's substantial enough compared to our gross revenues to establish it separately from all of the other stuff we do. So that's why we looked at the gross revenues when we did the department's math.
The 29 million.
The 29 million, not the 22 million, which is only trying to separate it out of rental. In fact, that's an admission. If you're trying to separate this solely out of rental to do your calculations, then you're admitting that it comes from rental, which...
And there are no separate calculations, obviously, for these were services that were provided that were not provided in conjunction with the rental. This is going to the readily ascertainable discussion we've had. So there isn't any number. We don't have a percentage that reflects this is the amount. We're generating 20% of services that are not tied to the rental of equipment.
No, even though the department tried to figure out that to understand this case better, they weren't able to provide it. They couldn't answer, and they haven't, and the accounting system was unable to find that information easily. So,
Under either scenario, and I keep coming back to this, but if we're looking at the 22 million, let's take their number, the 22 million, and we're comparing the total for the three separate categories, we're still only looking at 9.7%.
right. So even then, I don't think we should, because that's
I
admitting.
know that's your position, but my question is, since you didn't give an answer to Judge Catania about what percentage, you just said this is not, this is, where does 9.7, or even your number, when you're looking at the total, was 7.5? So where do those percentages fit within the test?
I believe that they're closer to the not substantial. And I also say that none of these prongs do give us an understanding of the case, but the other facts here show that this wasn't a separate business, that you have to meet all three prongs, and if you fail any of them, it weighs on the fact that this isn't a separate line of business, that even if this 9% is not substantial because it's also connected, it can't be separated. They fail the prongs, that substantial prong, because they can't do the other things like actually calculate the amounts, whether it's 8 or 9, or 7. I know there's not an answer, and I don't want to give an answer because I don't know that the Supreme Court intended to say what a percentage was, that if it's under 17, it's not, and if it's above 17, it is. I think that you have to look at each of the facts of the case and rule on each of those facts. And the facts here show that they claim it's 9. The department says it might be 8. We know that it's not ascertainable. They couldn't answer the other things. So these numbers are kind of fluid. And in this case, that argues against them being substantial because they can't establish things to show that these numbers were clear. The department never actually admitted to these numbers. This is the upper limit on the numbers. The department wanted more information about these things, which they were unable to provide. So in the department's argument, it's even accepting the upper limit of the numbers that you provided as the numbers, it's not substantial. Whereas,
And you're talking now about the numbers of police revenue is 1.1, flagger revenue is 900,000. That's what you're talking about.
yes, that's what I'm talking about now, that those revenues are the upper limit, and they were not, they may have been able to provide the invoices. The department had a different position to the other numbers, that some of the things shouldn't have been included because of some disputes, and they weren't able to clearly identify all of these things that should have been part of that separate classification. Not just split up the flaggers once they separated them into two smaller parts. They couldn't even identify everything directly, and we were fighting about that the whole time. And that goes to show that the number was probably lower than what they have claimed it to be. And again, it's their burden. The way the transaction privilege tax works is that it is a tax on the business. It's not a tax on specific transactions or sales. That's in the cases in the statutes, it's gross receipts tax. And after something falls into a taxable bucket or a taxable classification, then it's the taxpayer's burden to remove that from the classification, whether by proving that it qualifies for a deduction or establishing the prongs to show that it is a separate line of business. The statute ARS 425023 shows that it's their burden, that it's assumed that everything is within the classification once you're in a classification, and then it's the taxpayer's burden to show that it falls out. And they have not done that. They have not provided clear documentation. They have not established that.
So what if next year they separate out the planning, flagger, police officer, service industry, and they have 4 departments? How does that change the analysis?
Well, if they were to do it on their accounting records, which they didn't do here, then that may allow them to show that one of the prongs, that it was more easily ascertainable if they kept better books and record. But it would not separate them on the other 2 prongs, which that it would be
Not inconsequential
because it would.
And not incidental to another part of the business. So they separate it out, and they're able to tell you, we provided this many police officers to other functions not related to our rental business. We provided this many flaggers to other construction companies. And they start to show that inconsequential. All we have then is the second prong, which is inconsequential revenues. So does that change your analysis at all?
Well, here the amounts of their revenues are still inconsequential, even had they been able to separately separate them in their books and records and accounting and track it, and the department had agreed to amounts, then it would still be less than the 43%, which was found to be consequential. In fact, it's substantially less. And
You divide it between 4 different departments, and let's say it comes up to 25%. So we're back to the what percentage tips the balance to consequential.
that'd be one of the prongs they would have to prove, but they would still fail, again, the third prong. So the third prong, they would have to be providing an activity that's not related to the activity they're trying to separate it from, which is the rental activity. So, I mean, from what I understand, you said they've been able to split the categories into 2 subcategories. The vast majority of one of those categories would still be related to the rental activities.
So the inconsequential would presumably only be revenues that were not generated while in connection with the other products that are being provided.
That could be, it could be that, but the fact that they are in the business of providing flaggers primarily to contractors or people who use them to put on roads and marathons and other things that do the road traffic safety,
It would be incidental to that.
It would be incidental to that. It would be, they're trying to separate it into a fourth bucket, a fourth container here, division or whatever, but there's still, the vast majority of this container is still rental business, and so therefore under the statutes for transaction privilege tax, once you're in that business, once this fourth bucket is in that business, then the gross receipts from this bucket are also taxable as rental. So they would have 2 rental buckets. Even though they'd be clear and there'd be 2 rental buckets, it would still be the second one, and all the receipts would be from that would be taxable. Unless, again, they could somehow establish that they could split that bucket into something. But then those amounts would be so much smaller compared to the gross receipts from all their businesses. I don't know that they could establish it. Finally, I wanted to talk about the third prong just a little bit. They're trying to say that the flaggers who handle equipment that is road traffic safety equipment, they're saying that they're flipping a sign that says slow or stop or go or that sort of thing. They're saying that what that activity they're doing is not incidental to the rental activity, and that boggles the mind. I mean, somebody holding a piece of equipment that's rental equipment is somehow not related to the rental equipment activity. That they fail the third prong, I think, strongest of all of the prongs. There's fights over the other 2 prongs, but the third prong, all of this activity is related to their rental business. It's for the same customers almost entirely. It's directly related. These traffic control plans were provided in order to get the customer to a place where they could then rent them, because they had to get a permit from the city first in order to rent equipment. That it's all incidental and related to their primary business, which is primary rental business, which is the rental of the traffic control equipment.
But if it's a relatively simple activity and you're essentially just providing some unskilled labor that they could provide themselves, if you just gave them the equipment that just requires someone just turning a sign, that does sound more like, well, we're just providing some labor that if they could just as easily do it themselves, although I don't know that that's the state of the record, that it is something that you need some experience in handling this equipment or not.
Well, again, we can look at the Arizona Rent-A-Car case, and it tells us the answer to that question. In the Rent-A-Car case, the rental company budget was selling gas, charging a refueling charge to refill the cars with gasoline. And even though, had that been separate, a gas station is not taxed as rental. But because they're providing it as part of the contracts, showing that, this is a charge on the contract, it was found to be part of the rental business. Here, they're providing it as part of the same projects. So they don't have contracts to state that this stuff is separate, which is a mark against them. But they have invoices and projects, and they're part of the same projects. So whether in isolation it can be viewed as possibly a separate labor or activity, in the context of their business, it is part of their business. All 3 of these activities are. And so they would fail the third prong, even if they could separately account for it and do better accounting and have larger amounts. They would still fail this third prong because of the nature of the activity and the facts in this specific case. Just like in the car case, the car rental case, the gas was part of the rental activity because of its relation, its tie-in, and how it was provided. When you rent a car, you have to refill it, that sort of thing. No further questions? Thank you.
Mr. McFarland.
Thank you, Your Honor. Again, Your Honors, this is the taxation of personal services. And really the issue here is what is encompassed with the personal property rental classification in terms of other services that are provided in regard to that. We've heard today that RTS has many lines of business, and therefore the TC activity is not uniformly performed with each TC equipment rental, and one does not beget the other. The business here is the personal property rental business, which is the rental of personal property. The traffic control activities on the other side here are not personal property rental, involving rental of personal property. Therefore,
seem to be incidental to it, and the argument would be more compelling if you had a separate bucket that were identified that showed this is the amount of labor that was expended for these activities that was not ever, did not relate to another project that we had, the rental of the equipment.
And that, Your Honor, is stated in the invoices, in the primary documents here that were reviewed by the state's auditors, and they had no complaint with any of the documents there. The invoices, if you take a look at them, many of them where there was labor involved, it'll say truck, 2 men, and it'll give an itemized line there. When there's a flagger, it'll say flagging, and it'll give hours and the rate. If there's police officers, it says police officer, hours and rate. So they're identified separately, and under the Abasco holding, you can sever that as a separate line of business for purposes of determining TPT taxation. And so if and yes, I understand, okay, it's a minimal amount of dollars that we're talking here, but nonetheless, the statute, if you take a look at the statute, I think the statute is clear and unambiguous. If it's not a part of the rental transaction, I don't think that it can be included in the rental classification. It could be some other business classification, but in this situation, it's not. And I'm out of time, Your Honor.
You said you're given more time. Do you have any more questions? All right. All right. Mr. McFarland, I'll give you another 10 seconds if you've got a closing something.
Yes, Your Honor. You know, we've discussed you know, the impact on the industry and other businesses here. We need some a holding here, I think, in this situation so that businesses can understand if they've got a taxable transaction going on here. And if you base your holding on the statute here, which the Supreme Court directs that we look at first before Abasco, before Holmes and Narver, I think you will find that the personal services of the TC activity is non-taxable. Thank you.
Thank you. Thank you both for your arguments. This matter will be taken under advisement, and we will issue a written decision in due course.